All right, let's jump in today. We're going to keep it short, but been doing some work on just a modification of the 112 trade. We've already been doing a little bit of it, but I want to explain it a little bit longer here today and why I think this might be the best version of the 112 trade that we have going. So I actually put a little PowerPoint together. So let's jump into that today, and let's talk about the LT112 or the long-term 112 and why I think it may be the best version of the 112 yet. So when we look at the 112 trade here, and you look at the setup on the standard 112 trade, let's just walk through that with everybody here. This is out of the trade plan, and Michelle in. So this is right out of the trade plan, and this is typically the setup. You're looking, the way I've switched it this year is I've been looking at a weekly trade using ES futures for the 112, and I will ladder up to 8 of those on. We'll go through these. We'll show a little bit of it here today. Typically, I'm getting around $10 credit, but it can be up to 14 or so on these. Again, with the 50 multiple, you're making around $500 a week or so on these, using about $8,000 in buying power. So if I'm laddering these on, obviously, with the 60 DTE trade, that's 2 months out. You're going to have to ladder 8 of these on. You're going to have enough buying power for that. But if I'm making 500 a week, because I have one on every week, on Wednesday when I put these on, that should generate around $2,000 a month. The BP required on this is if you put 8 of these on at around $8,000 in buying power, obviously you need around $64,000 or so in buying power. So with about $64,000 in buying power, that would mean you're going to need somewhere in the neighborhood of a $130,000 account or more to be able to put these on. I'm trying to keep up with all the people in the waiting room, which is a substantial amount of money. Obviously, we can use MES and things like that as well. But let's just stick to the basic trade here. Put these on around 45 to 65 DTE. Again, the ideal for me was 60 DTE. That's what I found to be best when we back tested it. So when back testing these, I found 60 DTE to be the best. And then I've been putting these on around 50 wide. That's the put debit spread that I put on with this particular trade. And again, I back tested 30, 40, 50 wide, different DTEs. And what I came up with over the last several years, which was both a bull market in 21 and a bear market in 22. So 2 completely different markets. I wanted to see what worked best, and the 50 wide worked best over the 2-year period. The 30 wide worked better in 21 in a bull market, and the 50 wide obviously works better in a little bit more of a bearish market. So we'll talk about those more as we go through the year and as things change, but understanding that if you're doing a 112 trade, the 30 wide in a bullish market is going to be the better trade of the 2. And then if you're in a more of a bearish market like we were last year, you're obviously going to be a lot better off if you were in the 50 wide, but a lot better off in a bearish market. And somebody had asked a question, how do you determine whether you're in a bullish market or a bearish market? Well, for me, pretty simple. It's just trend and maybe the 200-day moving average. And on the daily, and right now the trend's been down for quite some time on the weekly and the daily, and we remain below the 200, or though you're now just starting to potentially pop above that. It doesn't mean we're in a bull market now, but I'll wait till that 50 crosses above the 200, and maybe that'll give us some indication that we're You know, maybe out of the woods soon, but I still think we have a little bit more of a dip coming back. So anyway, it's just looking at trend, looking at where that 50 and the 200 are, and just getting a good sample of whether we're in a bull or bear. Anyway, there's the basic trade entry. And when you take a look at these things, on the weekly version that I'm talking about for this year in the trade plan, if you put one on every week, obviously it's 60 days. It takes 2 months for these things to expire. So you're going to have to ladder up to 8, putting one on every week. Now, you have less buying power, different things. You know, maybe you do one every other week. You know, if your buying power is less, but you still have 60 days to wait. So if you're going to do the weekly, like I'm talking about, one a week, you get $10 in credit, which gives you about $5,000 in cash, which gives, and you're using around $8,000 in buying power in a standard account for these. You know, it'll take you obviously 4 trades. You know, if we're putting on the Marches right now, you know, 4 more trades to put on all 4 weeks of April. So you're looking out several weeks, and you're going to end up using about $64,000 at all times. So if you've got these on and you've laddered 8, typically you are somewhere in the neighborhood of using that $64,000 when using ES on these at all times. So that 64, once you laddered 8, it doesn't change. One comes off, one goes on. One comes off, one goes on every week. You're really not going to, you know, get higher than the 64. Obviously, it's span margin, and if there's a, you know, a significant down move that could go higher. I'm really just talking about when you put these on. It's around $8,000 in buying power, and that's really what I'm looking at initially here to make $4,000 over that 8-week span. So we're going to keep making $500 every week. That $64,000 is going to keep yielding us around $4,000 total over those 4 weeks. Here's the current trades that I have on, so you can see what the actual portfolio looks like for Income Navigator for these. Pretty close to 1 a week. Might have the wrong dates up there on one of them, but anyway, that's what you're looking for on the 112s that I currently have on. There's one down at that $6.75 credit. That was one of the early ones. But pretty much since then, they've all been right around that $10. So they're yielding around the $500 and pretty close to that 64. So give or take a little bit here, it's still around $8,000 buying power for these trades and around $10 credit, which is about $300 in cash. So overall, this is what you can expect to make. If you're using one contract and you're selling one weekly, okay, and you're making $500 every week, and you're using $64,000 in buying power on your account, and I don't care what your account size is or the whole 50% thing. I'm not worried about your accounts. I'm just saying if you're putting one contract on of these every single week, you're going to use throughout, you know, you're going to always be using 64K. And at the end of the year, you'll have made $24,000 on your 64K. Which is a nice return. I mean, 37.5% return. I don't know who wouldn't take that as a return on a single strategy in your account. Now, you may have other strategies adding to that, but that's a pretty nice return. No, you're not 100% invested. So if you have a $64,000 account, you don't put all of these on. You're going to have a larger account. So if you had a $130,000 account, you could do this, use 50% of your buying power, and this could be your trade. Now, obviously, the $24,000 is based on the buying power usage. Obviously, if you had a $130,000 account and you were using only half the buying power, you would be making half of this, which would be 18%. So still pretty nice. That one strategy, that if you only used one strategy in your entire account, you'd be making 18%. If this is just one of your strategies, it's a good, consistent 3% a month strategy. And this is assuming that we only go up. That means we're in a bull market, we only go up, and you only get the tail profit. This does not take into account the fact that you might drop down. You might actually get a few of these in the trap. I mean, you're putting 4 on a month. You're putting 48 trades on a year. The odds of a couple of those getting in the trap is probably pretty good, especially in a choppy year or a down year like we had last year. And I think we're going to see a chop year this year. I think we'll see some nice rally for a little bit here. Then I think mid-year, we're going to start to tail off and go down. So if you get a little bit of both, you're looking pretty good. So this is, hopefully everybody's on board with exactly what I'm talking about here when you're doing the 112. But I want to talk about the long-term 112. And this was just something we stumbled upon a month or two ago. I put 1 or 2 on. I put 1 on in my IRA. I actually put 1 on in this account, but just 1. But I've been playing with it more and more. And when you start to look at these things, you really start to find the power of the long-term 112, which is, to me, a far better trade than anything I've seen so far. Nothing's the holy grail. There's downside to everything. Don't run out and mortgage your farm for this whole thing here. Be smart. But I love this trade. And I love it so much. I'm moving to this in every single account I have. My IRAs have these. I'm going to look at them in a lot of different accounts. However, the difference here is it's a monthly trade, and I'm going to talk about some different versions of it. But let's just say we were going to put this on once a month because it's a 120-day trade, okay, which is a 4-month trade. So we're going to do, I looked at 90 DTE. You could do that as well, but the 120 actually works even better. It's hard to pass it up. So I'm just going to talk right now about putting 1 trade on a month. You'd ladder up to 4 of these at any given point in time. Okay, so 1 in January, 1 in February, 1 in March, 1 in April, because you're doing 4 months out. And then every month you'll take 1 off, put 1 on, take 1 off, put 1 on. It's the same basic premise, except now we're only doing 1 trade a month and we're not doing 4 trades a month. We'll talk about some of the pluses and minuses of that in a little bit. However, this particular trade, you're going to see closer to about a $22 credit on average. Whereas on the standard 60-day version, you're looking at about a $10 credit. Here, you're looking at a $22 credit. So now you're going to be generating around $1,100 a month. Okay, you were generating $500 a week before. Now you're generating $1,100 a month. I get it. We'll keep moving on. But the beauty of this thing is the buying power is almost at least a quarter less. So on the standard 112, we were looking at about an $8,000 buying power per trade. Now we're only looking at around $6,000. I was putting some on today, and it was even substantially less than that. But I think that might be because I have some other trades on, so I didn't want to base it on that. But now you have 4 trades on using only $24,000 in buying power. Okay. So now that really changes the game. The fact that there's a lot less buying power on these and the income is double. So you get twice the income on 25% less buying power, which is really pretty powerful on this. So trade entry on these 120 days. I'm not changing any of the setup. I'm still putting a 50 wide PDS on, around 25 delta for the long, going 50 wide. And then I'm selling 2 5 delta puts roughly on those and looking at placing a new trade every month. Maybe it's the first Wednesday. I like Wednesdays. Maybe it's the second Wednesday. I know some of you are thinking, well, but it doesn't give you as many different strikes. And what if you pick the wrong Wednesday? Well, what if you pick the wrong Wednesday and you only make a ridiculous amount of money? So I think the argument is we can do more with it. So let's keep rolling down the track on these. So when I look at the monthly here, and I spelled monthly wrong, but if you look at the monthly here on these, you'd have 4 months worth of these on. your buying power would be $24,000, but you'd make $4,400. So I'm making $4,400 using $24,000. Remember back here, I was making $4,000 using $64,000. Okay. And I had 8 trades working at a lot higher BP. So you can make $4,000 on 64, which is what we're doing now, or I can actually make 4,400 on almost a third the buying power. Okay, so I can use a lot less buying power to make a lot more money on this one. To me, this is a beautiful thing. So with only 4 of these trades, I only need 24,000. If I had a $50,000 account, in theory, this could be the only trade you put on, and you'd make essentially $1,000 a month in a $50,000 account. Okay, which would give you at the end of the year, there's that 1,100, times 12 is like 13,200 on a $50,000 account using only 50% of the buying power is a 26% return. But when we look at this thing, here's what would happen if we used 2 contracts. And why did I go to 2? Because if I had the buying power to be doing these with 64 grand worth of buying power to make 4, well, then I should have enough buying power to use 48,000. So I could put 2 of these on. For those of you that want to, not put 2 trades on at the same day, I could go every other week and do it on every other Wednesday. So maybe you spread out your strikes a little bit. Maybe it's a little less risk on it, so it mitigates a little bit of the risk because you're a little bit more of a dollar cost averaging version in there. But if I'm using 2 contracts every single month, putting this on, remember, my maximum margin is going to be $48,000 because at any given time, I'm going to have 4 trades of 2 contracts. So let's just call it 8 of those. So 8 of those, again, at $6,000 average buying power is 48,000. So everybody with me? Yes, 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 hopefully. Didn't say anything that's confusing to anyone. So again, if I'm sitting here, yep, good, yep, everybody's good. So we're sitting here on 1 trade. I could be making 4,400 using just 24 grand on 1 contract, 1 a month, or I could just double it up, okay, and make 2,200 a month on 48 grand. And now look at the return. Remember what that return was back here? I thought 38% a year was pretty damn good. Okay. Now, do you think 55% a year on a single type of investment is pretty good? Yes. And don't forget, on this, you aren't calculating any trap profit on this at all. You're making 55% a year on a single style investment. I'm not saying go all in and make this your only trade that you ever do. Okay. But who doesn't want to make $1,000 on every $6,000 worth of buying power? Okay. Is there risk? Of course there is. I'm not saying this is a non-risk trade. Okay. But this is a pretty nice return when you look through the whole thing. And then let's take a quick look. So I pulled up a trade from about an hour or so ago. So I dropped this trade in. This is how it would look. We can go I'll do a live one here in a minute. But this is what it would look like. So I went out, we didn't have 120, but we had a 116-day trade. So I went out 116 days to May 19th, put on pretty much the standard style trade right around the 25 delta long, 50 wide on the short, and then going out to about around 5 delta and buying those 2 puts. Now, here's another magical thing, and I didn't build a slide for this, okay? But I could build a slide for this. When you look at the long or at the naked puts, look where the strike is on that thing. And we're gonna compare it in a minute, but you're at least $200 to $300 lower on the naked puts at 120 days than you are at 60 days. higher, you're out farther, higher vol, all of those things. But you're significantly lower. Okay. And because you're lower, to me, it's a much safer trade. Can we breach 31.75 in 4 months? Heck yeah, we can. Okay. But I got 4 months to deal with that. Okay. And I've got a much flatter line. Okay. I have a much fatter trap. And the profit inside the tail here, again, it's 100, it's $1,230 on this particular trade. I'm getting $24.50 credit here, and my buying power on this one is around not quite $6,000. Okay, that's a pretty good return. So pretty good return on these as you look. And let's take a look at. I'm going to pull up the trading account here today. So let's share on these. So let me reshare and let's take a quick look. All right, here is the Income Navigator account. So I've got 7 different accounts here between IRAs, other trading accounts, and then the IN account here. So let's just show the IN account. Having a decent year so far. We're up 10 grand already this year. We started around 260 grand. And we're up 10 grand on it already. And the biggest drag for us is always these SPY long puts. I'm okay. I put these on 4 months ago. So I'm okay with giving myself negative delta and taking the loss. If we would drop, I'm all good. I got negative delta. I feel pretty good. But let's take a look at putting on an ES trade. But if we were doing the 60-day, we'll use this 50. Let's put a 60-day trade on right now. If we were doing that around, again, 25 delta, we'd be somewhere in here for the PDS, and then we go down to about the 5 delta, somewhere around 34.30. Okay, and this would be roughly the PDS that we would be putting on, or the 112. Here's our standard 112. We don't have 52 days, close to 60. And you're at 34.30, about an $8,000 buying power. Okay, still a good trade. I mean, this is what we're doing. This is what we've been doing. This is where we've been making money. I mean, who can blame this type of a trade when you're taking a look at this thing on a standard 112? Okay, there you go. Standard 112. I make $500 on 8,000. Okay, who doesn't like that amount? Okay, that's a 6% return. That's always been our return. 6% in 60 days is 3% a month, which is my target every month. It's just 3%. If I beat it, great. Usually we do. Okay, if we so we jack it up with other trades like if strangles on futures. We jack it up with other trades like the strangles on gold and ES. So lots of different things that we do to add more income to beat the 3%. And this is only a third of our account that we dedicate to these. But look at that again. 3,400 is your downside before you start to go negative. Okay, so 3,400 is somewhere around, I don't know, 3,800. Okay, so I'm going to write that down, or I could type it in chat, but 3,400 on the downside, and the upper trap is about 38.25. Let's just use that. 38.25. That's our standard trade right here. Boom, put it on every Wednesday, make money, love it. If we drop into the trap, great, we make even more money. You go from 500 to usually 2,500 or so, because usually we're closer to that 10 piece. So you go from about 500 to 3 grand or so. It's about a 5x return. But let's take a look right now at what the differences are when we go to the 120. I'm going to use the 116 because that was the example I used earlier. We're going to go to the 25 delta, sell the long. We're going to go 30 wide, okay, and buy the long, sell the short 50 wide, and then we're going to go drop down. We're just going to stick with the easy, 5 delta, 2 of those, Okay, and let's put this particular trade on. Let's take a look at what this one looks like. All right, so here's what this particular trade looks like. So let's look at the differences in this trade. Number one, the buying power here, $6,000. As I mentioned earlier, you have less buying power on this trade. Automatically now, I've already saved $2,000 in buying power, and my income now is about $1,160. Okay. I've doubled my money on less buying power. Okay, I mentioned it the other day, and that if you could make $1,000 using only $6,000, would you do that? Right. So that's the initial trade that you particularly put on. But let's also look at the size of the trap as well. So your trap profit goes higher, but now the break even down here is closer to 3,100. What was it before? Remember? It was 3,400. So I actually dropped another $300 down here. Now, $300, okay, for those of you that are mathematicians, $300 is another 7.5% farther out of the money. Okay, so you're now looking at an additional on this trade. Not only are you using less buying power, okay, you're going to drop down in here on the initial trade. You're going to drop down into here, but you're giving yourself an additional 7.5% downside room. So what's the market at now? What, 40.60? And this takes you to like 3,100, 3,125. So from 40.60, that's what, $960. My total drop here is now 24%. So if the market drops more than 24%, okay, now we have to deal with the downside. Okay, which again, we always have to deal with the downside. I'm much more willing to take assignment at 3,100 and roll and do whatever than I am at 3,400. Okay, so I don't know about everybody else, but I'm much more willing to want to take assignment or roll or do whatever down around 3,100. So I've given myself extra room. And now the other thing that's really significant is, remember the top of the trap before, okay? What was it, 38.25 or so, which is, right around here. You've really only dropped a small fraction to 37.60, only about a $60 drop. So the trap is starts at almost the exact same location, but the downside is significantly farther away, 300 points farther here. But the top of the trap is almost identical. It was 38.25 before, and now it's around 37.60 or so. So your trap, the entrance to the trap has stayed the same. The bottom of the trap is 300 points further out. So much safer trade. In my opinion, it's a much safer trade. Longer trade, more risk maybe. But much, to me, much safer trade, because I've given myself more time to be right. Okay? More time to be right. More income on the same amount of money that we've had. So there's the reasoning behind it. When you look at these two trades, you really make a big difference in there. Someone's asking, what happens if you get assigned? I mean, you guys all got to check that out for yourselves. But what happens if I get assigned, okay, on, I don't know, I guess it would be that particular day, but what happens if I get assigned right now on a strike from today? Okay, well, it's going to use up in this account about $14,000 for this particular account for that one contract. So if I do get assigned, it's going to chew up about $14,000 in buying power. Sorry. So, but every broker is different. Stas, I think, put it in there too. Depends on your broker. Then for some people on different platforms, it may not be, enough difference. But those are some of the things to take a look at. I like it. I think it's a good opportunity trade. There's pluses and minuses. You can change on some things here. Span margin is going to affect you either way. If we drop hard, span margin affects you any which way. However, when you have a longer trap and a farther downside, okay, span margin is going to, the curve is going to be less. So a drop, I'm not talking about span margin, but the loss on the drop is not as big on these as it is on the 60-day. But yeah, if span's certainly going to affect you, and so is the downside. You have it on both. So I don't see a greater risk here, except the fact that you're in the trade longer. However, I'm using less buying power. So it's okay. I'm going to have less trades on. Either way you do it, you're going to have less trades on, and less trades are going to affect you less with span margin because you have less trades on. Okay. Currently now I have to have 8 trades on over 60 days. So I always have 8 trades on. Moving to this, if I did 2 a month, okay, I'd get back to having those 8 trades on, but I would start with less buying power. If I did 1 a month to give me the exact same size though of what I'm doing now, I'd only have 4 trades on at less buying power. So span is going to have a lesser effect on my overall account, because technically for the same income level that I have 8 trades on now, I would only have 4 trades on later, which is going to, again, you're using less buying power, less effect with span margin, less effect on Vega because you only have 4 trades on. Okay, so my overall Vega is not the same. My overall span margin is not the same. My overall buying power is not the same. So the question here is, am I sunsetting the regular 112 and replacing it with this? Of course I am. So yes, I am going to be moving that out a bit. So I'm already going to be starting to add a new trades in. I've got 60 days worth of 112 trades on in this account now. So I will be starting to add now. I'll have to keep it going for a bit because I don't want to lose money. And the soonest I can put these trades on right now is for May. So I've got to keep making money until May. All right. So in order to keep making money until May, I will have to keep doing the regular 112s as I add some of these in to the mix. But I think that's all good. My voice is probably not going to hold up much longer. Here, can you do it in an IRA? 100%, because the IRA accounts already have these in it. Okay, we've already got in the IRA accounts for the Income Navigator IRA that I'm using with you guys here. There already are 3 of these trades in that account, 1 for March, 1 for April, and 1 for May. So I've already been doing it in the IRA, and in the IRA, my buying power on these is about $12,000 for one contract versus 6 in the standard account. So in the IRA, it's doubling my buying power to 12, but that's still better than what I was doing before, because my standard ones were around, for the normal 112s in an IRA, was using about 18,000 to make 500, which was still a good return in an IRA, still almost a 2.5% return. Okay, but now I've gone from 18,000 down to 12, and I've doubled my money. So I now am moving these into the IRA, and I have 3 months worth in the Income Navigator IRA. And we're starting to crank up on that. So the IRA account for Income Navigator is moving up pretty nicely. I think we're up almost $5-6 grand this year already. So on a $200,000 IRA that we opened. So we're well over 2% on that IRA in the first 3 weeks of the year. All right. I'll probably wrap it up because I don't think my voice will last. Eddie, short so far out in the last 30 days should only be worth about, yep. And you could absolutely close that 100%. So as these things go, because you're so far out, unless the market is just tanking on you, you can absolutely close those long or those short naked puts. You can absolutely close those early because you're taking in so much credit. Closing them for $1 or $2 is an absolute yes to get those done. So you could take all of your risk off this trade quicker. You're going to make money with lower buying power. And this is the direction I'm moving on these particular trades. Love the 120 DTE version personally. So that's what we're going to introduce here today. Hopefully you guys got something out of this, gives you something to think about, gives you something to chew on. And the question is, last question here, any ideas on pushing the strangles out? Not yet. I haven't seen much of an advantage. However, the question on the strangles is the decay between 90-day and 120 is not substantially different, but I'm not seeing enough income on it. And let's take a quick look. All right, so let's go to a standard 90-day strangle. Let's go right around. I like to look at open interest. Let's just grab the open interest, the big open interest one. So open interest around 7. Let's go down to around 6. Here we already got something working, but let's just grab this one anyway. So if this was our strangle, I probably got to make a note here. So here's our strangle, typical 90 TTE strangle, and this one is what the 33.50, 45.50 for, let's say, for 24.75. I don't know if that's what it would fill at or not, for 39.60 worth of margin. All right, so let's go out in time a little bit to that 120-day. Let's take a look at where we are. All right, we got to get wider. Okay, let's go. Now we're going to go again to about 7 delta. I will pick I also look at these high open interest strikes, and I usually will up or down to those. I'm going to leave it here for now, but if I was doing it, I'd probably grab the lower one. And then here, 7's high. Let's just go here. Okay. So on this particular one, here on the 120, so instead of 33.50, we're at 32.50, so we're about 100 wider. And instead of 45.50, we're at 46.50, and our income is now, or our credit is now 28 versus 24 on slightly less BP, 37.60 BP versus 39.60. So it's only a $200 savings on buying power, so that's pretty negligible. You are a little wider here, but all I gained here was, from 24.75, let's say 25 to 28, was 3 points, which is $150. And I don't know if they'll still expire in 30 days, but essentially, if I'm taking 50% of that, I'd only be making an extra $75 by going out to 120. And I might have to wait longer. Does that make sense? Everybody understand that? So instead of a $25 credit, I got a $28 credit for almost the same BP, slightly less on the 120, $100 less on the 120 or so, or $200 less BP. But for $3 difference, which is $150, and then I'm closing at a 50% winner, it's only giving me $75 more to go out 120. And if I can close it quicker at 90, even a couple days, it's probably worth the $75 for me to do it. So I don't see a big advantage on strangles for these. I see the big advantage on the 112, primarily because of that downside. All right, that's it for me today. I hope this made sense. We'll pop this thing out in a video for you guys in the channel here. We won't be sharing it anywhere besides the service here, but we'll get this video out to you guys, and hopefully this was helpful to you. But the 120-day ES seems like a game-changing trade to me. We're going to be putting it on here. Obviously, I'm always putting my money where my mouth is, so I will be putting that trade on in the accounts. You can follow along, you can watch, you can see if I implode, or you can do your own thing. So always know your own accounts and your risk as you go. So have a fantastic rest of your day, everybody. The other great thing here too is, man, if I only have to trade once a month versus once a week, sitting on the boat, sitting on the beach, trading less. I don't want to work that hard. I don't want to be day trading out here. I don't want to be working that hard. I want to be working less and let my money work harder. So there's the reason for it. You guys have a great rest of your day. We'll see you in the Discord channel. Thanks, guys.